Hi guys, my name is Sanjay, and I have Bharat today with me, who is a full-time trader, ex-engineer, just to give you some context. And today, thanks to y'all, thanks to your polling, we're going to be discussing the topic of investing versus trading. So, Bharat, I'm going to sort of, probe a few questions, particularly around the trading side of things, because I come from an investing background, right? So primarily I look at investing as a long-term opportunity to create wealth. You look at things like fundamentals of the company, the technicals, the long-term vision of the promoters, and that's how I look at investing in the stock market. And in my mind, I think of investing as less risky than trading. Just because, once you put your money in as a common person, you forget it. You leave it there for 5 to 10 years and, you let things sort of play itself out, organically. But based on our audience's requests, and a lot of people today want to get into trading, although I think it's very risky.
Okay.
So I want to get your thoughts, given the fact that you've been in trading for about 11 years.
Very much.
So could you share your views and thoughts around trading specifically and how it could be compared to investing?
Yes. Hello all. Today, probably the question which Sanjay asked about trading. So two aspects. One is trading and the investing aspect. When I look at trading, I think trading as an instant gratification first and foremost. Because a lot of people today don't have the patience to commit their money to the market and hold on for 5 years, 10 years, 15 years. Because anything can happen in next 5 years, 10 years, 12, 15 years.
Right.
That is a risk you're taking about. Because when you're putting your capital into the markets, you are expecting some return out of it first, right? And you commit your money to the markets and you're expecting some returns, but anything can happen in next 5 years, 10 years, you cannot know. There are a lot of companies which are so-called blue chip companies have gone bust in last few years, few decades.
Right.
So basically you're arbitraging your own life, your destiny, because your hard-earned money, which you have a certain plan towards that money, because that will take care of your finances when you're about to retire.
I have one question though, at this juncture, is the compounding effect. I keep hearing about it, right? So people say you hold on, you stay invested, say in Reliance, for instance, right? If you'd invested in Reliance 20 years ago, the compounding power of staying invested for 10 to 15 years is something you can't see in the trading world. Is that true?
Not
because
necessarily.
I've not seen a lot of my friends who've got into trading come back with very positive comments to say, wow, I can, see multifold returns. I can see 10x, 20x returns in the trading side rather than staying invested in a company over a 5 to 10 year period. Is that true?
No, what happens when it comes to compounding? See, I don't deny the fact that it can be compounded, but if you look at the statistics, Reliance Industries was an underperformer for last about 7 to 8 years. It broke out of the consolidation of 7-8 years somewhere in 2016, 2017.
Sure.
And if you look at SBI, State Bank of India, which is supposed to be the largest bank of Indian market, it has been around 300 levels from last 15-16 years.
Right.
Okay. And if I can prove with statistics also, JPSO, which is supposed to be the blue chip company, which has gone bust, Reliance Communications, Reliance Capital, Reliance Power, Reliance Infrastructure, all the companies are blue chip companies. They're not small companies which have been promoted by the big guys. Right. Of course, the compounding can happen. I'm not denying it. But when it comes to trading or when it comes to markets, there are 3 kinds of markets: bullish, bearish, and sideways. Correct? When it comes to investing, you are only trying to say, I'm participating from the bullish perspective only. Bearish and sideways are discounted. You are not even participating there.
Point.
But when it comes to trading, I can make money when the market is bullish. I can make money when the market is bearish. And even in sideways market, I can still make money, which is not possible from investing. So in that perspective, I am compounding my capital at least 24-25% from last 5-6 years. Which seems to be, I think I am doubling my capital every 5 years, which seems to be decent returns. Not bad. Though I am still a little more conservative in my approach. I can be aggressive. See, now when it comes to trading, you should understand what is the risk I'm also taking.
I was just going to... So that is still something I'm not convinced about, right? The risk appetite and the amount of risk that you take in trading versus investing. That is something which is fundamentally something I've not been convinced with, for a very long time. Risk appetite, no doubt, it depends on the individual's risk appetite that you're willing to take, right? but the amount of risk that you take for the capital you're putting into the market,
Mhm.
is that justified? Investing, I think, again, like you
Very
said,
much.
I agree with you don't know what's going to happen in 10 years' time.
Yes.
I get that.
Yes.
But looking at any kind of market over a period of 15 to 20 years,
Mhm.
there's always the uptick. There's always the bullish
Mhm.
side of, the index levels going up. There's no index over 20-year period which has dropped,
Mhm.
right? But trading, there is a certain amount of risk that you need to be okay with. Now, is that something that you would recommend for the common person?
See, either investing or trading, equity market is subject to risk. Whether investing, so risk has to be managed.
Right.
You cannot evade a risk.
Right,
Evading risk is impossible in the markets. You have to manage the risk properly.
right.
So there are a lot of avenues where you can still manage your risk. Where you will not see the biggest problem with retail investors today is they always position size in the market based on the reward. That is the biggest problem. The
What do you
day-
mean? Could you just...
When I say reward,
Well,
let's say if I invested $100, if it goes to 130, 140, I make 30-40% kind of returns in a matter of 10 days, 15 days. When they're putting their money onto the table, they're only looking at one side of the coin, which is a reward perspective.
Right.
The opposite can also be true,
Mm-hmm.
right? Once you commit your money into the market, two outcomes can come. One could be rewarding, one could be losing trade. So when you're committing your money, if you look at the markets from the risk perspective,
Right.
then you are a little more decent with your position sizing. Position sizing as in how many shares I'm willing to buy into my Demat account, or
Sure.
if I'm willing to trade in terms of lot size or futures or options, whatever it is. So
Sure.
switch your focus from the reward perspective to risk perspective.
Sure.
Then you are not taking too much on the table.
So that's very much something like what I'd read recently in
Yeah.
Warren Buffett's book, where it's all about capital preservation,
Very much.
right? In terms of the attitude.
Yes.
I think it's a mindset game, right? Like you
Very
just said,
much.
it's not focusing on just the 30-40%, but really how do you preserve your capital,
Yes.
which is the way you look at it. Because the flip side, if you preserve capital, you're pretty much growing your capital.
Yes.
But it's how you sort of approach the game is what you're trying to say.
Very much, because I have understood, because one of a trader's friend of mine has put a fantastic quote. He says, how much money you make in the market is not important this year. How much money you made this year is not important. How do you survive in the markets for next 30 years is important.
Right.
You should switch your mind from reward to the business.
Right.
When you consider trading as a business or investing as a business, then you look at the market from risk perspective.
Right.
That is when market changes.
Right.
That is when the entire set changes.
That makes sense. So I would like to say invest for the long term.
Yes.
Right, so let's not say 40% of the portfolio, but it should be a combination of both.
Okay.
Right, there should be a combination of investing and trading, which really offsets all the risks that you could potentially, think of.
Okay.
But I think for a person, as a common person, not as a professional trader,
Yeah.
there should be a combination of trading and investing in your portfolio to really sort of see the benefits of the stock market that can, be brought to you. Would you agree with that?
I would see this exactly. I would agree partially with it. What I am doing with my capital, I'll tell you. I am trading. Whatever trading I'm going to make probably this year, I'm going to move the profits out of my trading account into investing account.
Right.
Okay.
Right.
So what is trading giving me? Trading is giving me the capital, whereas investing giving me the wealth. But when again I'm a little more cautious about investing, because
Of course.
you never know, many companies would go bust.
Right.
Even if you look at not Warren Buffett, the Indian Warren Buffett was Rakesh Jhunjhunwala. Look at the wealth that he has made,
Right.
and he has made wealth in only 2 or 3 companies.
Right.
Titan one of the biggest one, and most of the portfolio is actually bleeding.
Right.
Right, so you should be a little more smarter when you
Correct.
start investing.
Correct.
So I would prefer a little more like a pharmaceutical company, not pharmaceuticals, FMCG, where I know you should have to brush, I have to brush.
Right.
Correct. So HUL, Dabur,
Right.
FMCG, which is a low beta stock, which I'm a little more comfortable with. I invest in that.
Sure.
Instead of making a mutual fund investment, I would
Right.
rather take my money, start doing the same money into SIP,
Right.
into individual stocks right away.
Sure.
So this money which I'm putting into investing
That's
is
your
the
wealth.
profits.
That's your wealth creation versus the
Yes.
one that is creating your wealth is the profits from trading.
Yes.
Right.
The capital is actually drawn from the trading.
Sure.
And that profit that I have earned
Sure.
from the trading
Sure.
is put into wealth creation through
Right.
investing.
Right.
So I have a combination.
Okay.
Certainly I have a combination. But when I'm putting it, we can do lot many things into your investing portfolio also.
Of course.
If you have a trader's mindset.
Of course.
Because trader is always concerned about the risk.
Right. Right.
Correct? Because when it comes to trading, we call it two things. One is stop loss. What is stop loss? That means I'm accepting that my entire analysis went wrong. I'm accepting my losses.
Correct.
Right? When it comes to investing, you average it. I am not the person who would average my loss.
Right.
Okay, I would not average my loss. Instead of that, I will start dealing with tweaking my trades, because I have investing portfolio with my trading mindset. I would tweak my portfolio such that whatever losses that's happening onto my portfolio
Right.
through investing is actually hedged.
Offset. Yep.
Hedged
Yep.
with my trading mindset.
Fair enough. I think that's very well put. That's so. I think to an extent, my investing mindset needs to be paired with a bit of a trading,
Very much.
activity on a daily basis.
Because you cannot say that I am an investor, I commit my money to the market for next 5 years, 10 years, 15 years,
Right.
and you can just relax.
Correct.
You need to watch your investment portfolio
Correct.
every now and then, assess it. If something is wrong, you have to switch your portfolio.
Yep.
Otherwise, it's not a forgotten story.
Right.
After 10 years, let's assume, God grace, if it works in your favor, fantastic.
Yep.
If it doesn't work in your favor, the entire 10 years, the capital is gone.
Gone.
Time is gone.
Correct.
Capital is okay.
Correct.
The time is gone.
Time is gone.
Time is money today.
Correct.
Correct?
Correct.
So you should not lose time.
Correct.
That's what. It's not forgotten story, sir. Invest and you can relax. No, go look at
Yeah.
you guys, whoever is watching it. Go look at State Bank of India, supposed to be the biggest bank of India. What is the performance? If you were an investor, what is the returns you would have expected in last 15 years?
Right.
Go look at it. It's not that easy. You cannot just choose 10 companies, 15 companies, blue chip companies and start investing and say, yes, sir, market will take care of me, my retirement, my family.
Correct.
You cannot do that.
Correct.
You have to be active in your investment. You have
Absolutely.
to be active in your trading.
Yeah.
You need to wear a trader's hat and say, if something is not working, I have to switch my portfolio.
Right.
I have to do appropriate fixing into my portfolio,
Right.
such that your investing and trading will go hand in hand.
While you were saying this,
Yeah.
what I and correct me if I'm wrong, right? It feels like the capital markets, whether it's global, whether it's Indian, it's an ecosystem. You got to understand how each person, each component of the market impacts the other, and really, that's when you can really magnify your or the efficacy of your portfolio, the effectiveness of your portfolio is truly understood and gotten when you understand the entire ecosystem,
Very
how
much.
the capital markets work,
Yes.
and what are the different components. Because I think a lot of people right now in the market, like I think, correct me if I'm wrong, it's about 2% of the population in India
much.
who's actually
Having
investing or
active
trading
demand
in the
accounts.
markets, right? Which is, there's a lot of scope for people to actually
Very
use
much.
the capital markets to their benefit, right?
Very much.
And that comes with really understanding how the markets work. What are the different options available?
You should understand.
Right.
Because India being the most conventional country, the most probably preferred asset class would be debt markets.
Right.
And they think debt market is safe, nothing to worry about. It will take care of, it will churn 8%, 9% returns year on year.
Correct.
But please understand, IL and FS fiasco last year in September was probably a nightmare to a lot of people.
Yeah.
Because equity market is subject to risk. I understand this.
Correct.
Debt market is also subject to risk.
Right.
It's not that because bank can go bankrupt, sir.
Correct.
Correct?
Correct.
So you cannot have this attitude of laid back attitude of saying, yes, debt will take care, equity will take care,
Correct.
trading will take care. No. I would say 1% methodology. You are investing or trading.
Correct.
99% is you.
Yep.
Active, understand what you're getting into.
Correct.
Even not only equity market, not only trading, because we missed a word, even debt market is subject to risk.
Correct.
Yes?
Absolutely.
Obviously, yes.
Absolutely.
So you have to understand what is the instrument you're getting into.
Absolutely.
Once you understand this, and once you have this cap, trader's hat, risk management.
Yeah. I think that's
Risk cannot be evaded. You have to have risk is always there.
correct.
For you and me, we have risk. Can you guarantee that I'll live till 60, 70, I'll take care of my family?
Of course not.
Obviously not.
course not.
So we take risk.
Yep.
There's a risk.
Correct.
We are transferring risk to somebody else.
Yep.
Insurance companies.
Exactly.
Even in this market also, you have to understand the risk.
Correct.
You have to manage the risk.
Correct.
You cannot escape risk for sure.
I think
Equity, debt, trading, investing, irrespective of what is the market.
correct.
You have to understand the risk, manage the risk, look at the portfolio, trading
Correct.
or investing portfolio.
Correct.
Very, very timely. Very oftenly you should look at it
Correct.
and make adjustment to your portfolio.
So I think
Inappropriate words.
Go ahead, sir.
Before I parting words from my side, retail investors especially, you are looking at market from rewards, because every time I have seen the, retail investors, they said, if I invest money into the markets, can I make 100% returns, 200% returns? No, please understand this. It is not about reward. It is all about risk. Do not count your eggs before the hatch. And when you're committing your money, please understand the risk perspective of
Correct.
the markets, because equity market is subject to risk.
Absolutely.
Understand the risk, right?
Absolutely.
Do not think of how much money I made this year. Think of how can I sustain the business for next 30 years. You will make killing in the markets.
Correct.
Understood.
Very, very well put. I think the simplest thing what people sometimes say is, I did not know.
Yes.
I think we're in a world today where ignorance is not acceptable at all. Right?
Impossible.
The excuse people say, oh, I didn't know, I
Yeah.
think no longer is acceptable. Nobody
Yes.
can digest it. It's your own fault if you say that, right?
Yes.
So I think that's the most important thing, right? Be aware. Do not put your money in a place, in a stock, in a vehicle, in the market where you don't know how it works, right? I think that's the most important thing. Be aware of what you're getting yourself into. So with that, we would like to sort of, end this podcast, but stay connected, like we said, and sign up with SMI to gain more knowledge and awareness and become an expert in this space of investing and trading. So thank you, everybody.
Thank you.
And we'll see you next week.
Thank you.